Welcome back to Compliance Matters. I'm Robert Johnson, and again today I'm joined by award-winning payment regulations expert John Burns. Hi, John.
Hi, Rob. Good to see you again.
Yeah, welcome back. So today we're going to be talking about payment services, firms, and the regulator. The FCA seems to have changed its attitude to payment firms over the past few years. Why would you say that is?
Because they've woken up. The FCA, as I said in the previous session, didn't want payments regulation. It was thrust upon them. And so they tried to get away with doing it as light touch as they could. And they thought it was a low-risk area, and therefore they could get away with having minimal supervision and just act if and when there was an issue. What we have seen with failures like Vipagoo and Premier FX and some other firms as well have gone down, is that the FCA waking up to the fact that there are more customers actually using payment services firms rather than banks, which was obviously one of the intents of the first Payment Services Directive, was to allow customers to get payment services and allow competition to the banks in some other spaces. But what the FCA have now discovered is both failures in terms of customers losing money, but also they have seen failures in financial crime and anti-money laundering concerns. Now, if you are a money remitter operating through lots of corner shops in the migrant remittances space, you can see that you're relying on an assistant in the corner shop to do proper KYC and customer identification each time they come in is a problem on that, and it can't be relied on. And I think to an extent the FCA took a view the first time round that we will keep it as low key as possible so that we can, because if we make it really hard, then these firms will just disappear underground, and money it's not people who are sending money back to their families in their home countries are not going to stop sending money because a regulated firm isn't there. It will go some way. It will go underground. It will go through Hawala, or what I have heard stories of people being stopped on Eurostar with suitcases full of cash being transferred on that. So the FCA has finally woken up to the fact that there are concerns in this space, both in a couple of their areas, both in terms of customer protection and in anti-money laundering and financial crime space on there. And that getting up to senior management and the embarrassing stories means that the FCA has suddenly said, oh, right, we need to look, we think there's a problem here. So the pendulum has swung to the other side, where with C payment services, they automatically consider there's likely to be a problem here on it, so look hard. I mean, the other thing is, you're talking up towards 2,000 firms in the payment services space by the time you've got all these small payment institutions, small e-money institutions, and so on in that space. And that's a big sector to try and cover. I said before previously it was 2 people. So now we've got 50 plus. So it is, they've finally given it the resource to do it. And the FCA doesn't like people sitting around doing nothing. So if they haven't got anything to look at, then they will go and look for problems. So it's a kind of chicken and egg. The FCA has seen there's a problem, they've resourced it, but that resource is now looking for problems as well. So they're liable to find more because they're looking for it.
Yeah, I can see that. What would be the main areas of concern for the FCA, do you think, about the sector, and what can firms do about that to stop themselves from getting into trouble?
anti-money laundering and financial crime, as I said, particularly firms dealing in cash, is an issue that the FCA is concerned about. If you have agents, or if you're in the e-money space and you've got lots of distributors, then actually showing how you control them and what controls and how you can evidence that you've got the control on it is really key. To go back to one of the things I said in the previous session, the FCA's view is if it's not written down, it didn't happen. So showing that you've done the training, having the evidence of the transactions, so on that. Making sure you're safeguarding customers' money properly is absolutely key. The FCA has big concerns that firms are not doing this properly and they can't evidence they've done it properly. Now, firms that are able to use the Small Companies Exemption under the Companies Act are not required to have a safeguarding audit. I would say if you haven't had a safeguarding audit, then how can you prove to the FCA that you're doing safeguarding properly on it? Because they are quite likely to come and ask. So even if you don't necessarily have to, I would recommend that firms actually do get a safeguarding audit done. Having someone independent looking at it and giving you some actions you can take to correct things, it not only puts you in a better position, the mere fact that you've got someone independent to look at it shows the FCA that you're taking it seriously. I think if you're a big enough firm, I would say looking at governance, and actually if you can afford it, if you can find the right person, having a non-executive director is really helpful on it. I'm not looking for more positions myself. I have two, and two is quite enough for me. But if you can find someone suitable to do it, having that independent view of management is a really helpful sign to the FCA that yes, this firm is looking at governance properly and is taking that it's taking that right. And there's mood music to the FCA on that as well. Being upfront with them, telling them things. Again, that's one of the other things. If you're not sure whether you should tell the FCA about something, then you should tell them about it. Even if it's just for notification, even if it's not a breach, you send in a SIP 15 Annex 4 notification saying, we don't think it's a breach, but under Principle 11, we thought you should know about this, and this is what we're doing on it. Keeping that sort of thing going. So I think it's being positive and assuming, as I've said before, that the FCA might come and ask you at any time for these things. The worst thing if the FCA come and ask you something is that you're scrabbling to find the answer on it. Is your wind down plan up to date? Have you told them everyone about all your changes? Have you got reporting to board on wind down plans, liquidity, safeguarding, financial crime, so the board are seen to be engaged? Well, that's the other thing as well, board meetings. Board meetings are quite often minuted as this was reported, everyone nodded it through on that. I did actually have someone from an international, the company secretary from an international payment services firm, client of mine, phoned me up once and say she'd been asked to remove details of an argument from the board minutes because they wanted it to show that everything was sweetness and light. That's the wrong answer. You actually want to be able to show that there's challenge, that things are actually discussed on that. So proper minuting of board, proper discussions, having evidence of why you came to the decision is really key.
And this sort of level of disclosure is basically building a relationship with the regulator, isn't it? It's letting them see the honest truth. Even if it doesn't always look pretty, this is what's going on.
I mean, there are now half a dozen firms who are essentially relationship managed, really big firms in the sector who do have regular visits from the FCA and so on that, but most firms are not. And you're going through the customer contact center, and you're going to get someone who's just answering the phone who's got no real experience of it, and so on that. But things like notification, things like keeping the FCA updated on what you're doing, just sends a message to them. This firm is on top of things. It understands what its obligations are. It's telling that all helps.
So why is safeguarding such a high profile area of concern for the regulator?
Two things. One, because if it's not done properly, customers lose money. And the FCA then looks really bad because customers of a firm under its regulation have lost money. And secondly, because it's not done well in a lot of cases. As I said, mentioned us doing safeguarding audits before. And number of ones I've seen where things are just not done correctly. For example, the FCA's approach document guidance in chapter 10, which is safeguarding chapter, and I know that because I wrote the first version of it, says that in no circumstance should reconciliation be done less than once a day. We've seen firms do it once a week. We've seen firms who are apparently safeguarding with another e-money institution. And the requirement is that you safeguard with a credit institution. And the argument we always get is, well, we can safeguard with an e-money institution because they've got to safeguard. Yes, but they're safeguarding for their insolvency, not for yours. If you go bust, then that money's not protected and the creditors can take all the money. This is the main thing. If you're not doing it properly, customers will lose money on it and the creditors will take action, to claim all the funds. And that's really the thing. I think the other thing is, and one of the things in the financial promotions space is that people can have the view that it's covered by FSCS. Premier FX was a prime case. They were essentially telling their customers that it was covered, that safeguard, any funds they had with them was covered by FSCS, which it wasn't. And that messaging saying, this is how we're safeguarding, this is what happens, this is how you know that these things are properly protected is really key. I mentioned in the previous session, I think there could be an argument for safeguarding to be replaced by FSCS cover, which would improve liquidity in the market as well, but it's not just now. And making that message clear to customers, how funds are protected is really important on it. I mean, the other thing, one of the things in safeguarding the obligations that the FCA have put in is that you give a reason for why you're using the bank you're using for safeguarding. So you do a credit check on the bank. This gets a real hollow laugh from a lot of the industry because the idea that you go, bank, you're not good enough for our safeguarding account, we're going somewhere else. It's not really realistic, but it is particularly the case because post-Brexit, one of the things they did was say, rather than have the credit institution definition, which is in the directive, which is basically an EU authorised credit institution, that you can safeguard with a credit institution in any OECD country or anywhere else in the world, as long as the bank had a balance sheet of more than £5 million and didn't have debits, so it didn't have liabilities of more than that. And think, well, yeah, if you've got £1 million of safeguarding funds and you put it with a bank that's only got a £5 million balance sheet, then the risk involved in that is always great. I mean, I think one of the other things on that, just as an aside, is you really need to look at how the insolvency laws in the country of the bank where you have are going to work, and does that bank really understand what safeguarding is?
That immediately sounds perilous to me.
Yeah, I mean the other thing is potential time differences. If you're safeguarding with a bank in Australia and you've got 12 hours time difference, how do you manage just the practicalities of that? So yeah, it's interesting. But I'd say there is the insurance guarantee model. There's not many of them, but there are a few out there. We've just got another one approved by the FCA recently on that, but it tends to be expensive because the insurer or guarantors basically guaranteeing against insolvency. So they really want to know that you are solvent before they will underwrite that.
So you mentioned governance as an issue earlier. How should firms look to address this?
By making sure they are properly governed. So you've got a proper control. One of the things which I often say to firms is the senior manager and certification regime does not apply to payment services and e-money firms yet. It will at some point in the fairly near future. The FCA have been working with the Treasury on it, and the move ever is towards greater individual accountability of senior people within regulated firms. So if you act as if SMCR applies, you'll be in a much better position. So that involves things like having a management responsibilities map, say who's responsible for what. The amazing number of times that that's done, and you discover there's two people who both think they're covering the same thing, or there's a gap that everyone thinks someone else is covering on it. So actually doing that sort of responsibilities map, having that sort of process gone through to make sure that everything is covered and who's responsible for it is really key. Proper minuting of boards meetings and risk committee meetings, a proper risk assessment as well, an updated risk assessment. Number of ones I see from firms where I see the FCA saying the risk assessment had not been updated for since authorization, and it is one of the things. A lot of firms got through authorization, went, oh, that's fine, then we just get on with doing the business, and never update the threshold, the threshold conditions, the policies and procedures on that. Making sure everything's updated. There's a process for updating. The board are signing things off on it is really key, and that the board are really, as I said earlier, taking a real interest in the things that interest the FCA. So taking an interest in financial crime, anti-money laundering, safeguarding, wind down plans, liquidity, all those things are there, and that's minuted. If you got to all those things, you're in a much better position than a lot of firms in the sector.
Now, Consumer Duty came into effect a couple of months ago. How do you see that affecting the way the FCA regulates the sector?
I think the thing with Consumer Duty is that it's brought in with a new principle, Principle 12. And the thing with principles is alongside the rules, it gives the FCA so much more flexibility on it. You can't just say, I've ticked the boxes, because they can still say, well, you may have ticked the boxes, but actually we think what you did wasn't right on that. I think some of the stuff that's gone through, and we've got the huge template for Consumer Duty questions and so on, so you can actually go through it to show that you've actually gone through the process. And again, going back to that governance question, how do you evidence that you've done it on that? It is something that the FCA will look at in any case. If they start getting questions about things, one of the first things they'll look at is how have you done this under Consumer Duty. It's going to be really interesting. It's not payments matter, but how they deal with the big banks and the deposit interest question that they're looking at. Because what that enabled them to do was, when interest rates have gone up, immediately say, well, let's see your fair value assessments then on these accounts. How are you doing that? I think, again, going back to governance, what's something that payment services firms tend not to have is a real governance structure. When I was in Lloyds, I did 3 years in Lloyds as senior manager, compliance advisory and global transaction banking. And every second Friday morning, we had a product governance committee meeting, which I sat on. And that had people from all over the organization looking at each product. So every time there was a new product coming, every time there was a change to a product, at least annually, these things would come up, and we'd look at all the details and adjust things. payment services firms tend not to have that sort of structure. Now, I'm not saying they would have a meeting every second Friday morning. A lot of firms may have a single product on it, but they still got to go through the process. And it's really important to take account of customer feedback and actually be able to show you're taking account of customer feedback on that. How are you getting that customer feedback? How are you actually feeding this information in to show that you're actually being able to provide a good outcome for a customer? Now, in payments, it should be fairly simple in that a good outcome for customers, the money gets to where it was supposed to go in the time it was supposed to get there. That's fine. You know, it's not like a mortgage or an insurance policy or something more complex on that. But you know, customers, have they got the right information? Do they know how to get things? You know, how to provide the information that the firm needs? What feedback do they get? How is that all built in? And it's not that that money remitters say have to meet the same standards as banks, but what they've actually got to go do is go through the process and say, how do we know that the information we've got is sufficient in order to enable us to show that we've done it on that? I suspect a lot of firms, particularly smaller firms, have not done that, and they're in for a nasty shock when the FCA asks them for their consumer duty preparations.
What other difficulties have you seen with firms in preparation for consumer duty?
I think the one which is, I think, and not just for payment services firms, but across the whole financial services sector, is the fair value assessment. How do we say what is fair value? And I think particularly for payment services firms, a lot of it will be around exchange rates, because you're sending money internationally. How do you, what exchange rate are you giving? And it is something the FCA are quite likely to look at, because one of their concerns previously in the financial promotion space on this is that firms had websites that were showing an exchange rate, which was essentially the market exchange rate at the time. And people assumed that was what they were getting. They went in through the website, went through, and by the time they actually sent the money, the exchange rate they got was considerably worse than that was shown on the front page. So they're going to look at things like what are margins, what turn are you taking on the exchange rate? Because a lot of payment services firms, particularly in that space, will say, we'll send a payment for free. There's no fee for sending the payment because we take a turn on the exchange rate. But what turn are you taking on the exchange rate? Is that appropriate? Now, looking at what else is happening in the market, where we are on that, the profit margin you're making on it, is going through that process and being able to say, yes, we're comfortable with that, is something that I think firms are, they're looking for a tick box approach. So you can say, yes, that's fine. And I'm afraid that's not the way the FCA work now. The FCA work on the basis of, you tell us why you can justify what you're doing on it. I think that's an uncomfortable position for a lot, particularly smaller firms, of saying, hey, how do we do it? And it's one of the reasons I think that firms can use consultants as, again, someone independent looking at it and saying, well, why have you done that? Asking the questions the FCA might ask, but also being able to say, no, that seems reasonable on it. And having asked that question is a help to the FCA to say that you've got the, you've gone through a process, you have actually taken it seriously on that. So I think they have, I mean, a lot of firms, I think, haven't done proper preparations. They haven't put the governance process in place. They haven't really looked at firms. They haven't thought about what their, what a good outcome is beyond the money actually getting there on it. They are, I think, in a position where it's something new, it's completely unclear to firms. There's not a set of rules. And it's the same in risk, I think. It's the same in risk things. And so the FCA has stopped saying, this is exactly what you've got to do. They've said, these are the requirements. You've got to assess how you're doing against the requirements. And firms are really struggling with that. getting the customer feedback, I think looking at complaints and looking at saying, what are people actually complaining about? How are we actually dealing with complaints? A number of firms you see where there is no real way of complaining on the website. You can't find a phone number or email address. Looking at who your customers are and saying, these are our customers. Yeah, looking at customer vulnerability, actually. I did have one client once, this was before Consumer Duty, who was pulled up for not having proper vulnerable customer assessment by the FCA. And they said, but none of our customers are vulnerable. Their entire customer base was basically Bangladeshi restaurant workers around Brick Lane. If you look at the FCA's definition of vulnerability, they met all those things. And of course, they were doing all the right things to deal with it, but they've never taken a step back and considered, might our customers be considered vulnerable? Because that was, as far as they were concerned, that was just their customer base on it. So I think it's that ability to take a step back, which is why the FCA recommend that Consumer Duty Champion is a non-executive director on it, because it's someone who's not involved day to day, but can take the step back and say, why are we doing that? So yeah, I think it is that thing. I think firms, particularly smaller firms, have either ignored it because they didn't understand it and on it. I suspect a lot of small payment institutions have done that, or have just gone through some sort of tick box approach without really considering taking a step back and considering the detail on it. And if the FCA come and ask to do the holistic review we were talking about earlier, Consumer Duty will be up there as well. What have you done about that? So yeah, it's a difficult thing, but it's worthwhile on it, and being able to show that you're treating your customers correctly should be positive for the customers and positive for the firm as well.
That's great. What else can you see on the horizon then that firms should be taking into account of in their planning?
Well, as I said, the SMCR regime coming is, I think, something which firms should really be considering and acting as if. I think obviously PSD3 and the Treasury's amendments to the payment services regulations and e-money regulations is going to be quite significant. And I think if you are a payment services firm, well, as I said earlier, I don't think the potential rises in capital requirements are as big as they might have been. But if you're just getting by with your capital requirements as a minimum, and it's going to go up another 50,000 euros, you need to consider how you're actually going to get those funds into the account. Now, into your shares or whatever on that. Now, it is likely that when this is brought in, it's probably going to be 18 months, 2 years down the line, that there will be a transitional period, because the FCA are not going to say now. But getting that sort of additional capital in is not going to be easy for a lot of firms. So thinking about it now would really be an important thing to pick up. I think we can expect the FCA to continue to be tough on the sector and continue to look and continue to have thematic reviews in the space. One of the things that they're looking at ever more, and it's there in the FCA's business plan, is operational resilience, which payment services firms have always been responsible for, in a way that mid-sized FSMA firms are not. There's an oddity in the operational resilience requirements that the big banks, insurance companies fall under it, and the payment services, any money firms fall under it, no matter how small they are. And there's a set of requirements there which the FCA have never really picked up on. But operational resilience is up there in their business plan for the next 3 years. So I can expect payment services firms to be asked about their operational resilience. Now, said in the previous session, my view is payment services is the plumbing of financial services. It's how the money actually gets there. So you can see why the FCA are concerned about it. But there's a really significant set of requirements saying what would be intolerable harm to your customers in operational resilience. Now you need to make sure that ties in with what you've been seeing in consumer duty, apart from anything on that. But what is intolerable harm to your customers? How do you avoid that intolerable harm? Where are you going with that? So I would take a look at your operational resilience requirements as a fairly urgent matter and make sure that you're there, because it's quite likely the FCA will be asking questions about it.
Thank you, John. That's been a fantastic overview and insight into what payment services firms need to be thinking about with regards to the regulator. I hope that's been helpful, and thanks very much for joining me today.
My pleasure. As I say, always happy to speak to people about things if they've got particular problems. Thanks, Rob.
Fantastic. Well, look, that's all we have time for today. I'm looking forward to bringing you the next edition of Middlesex Partnership Compliance Matters. But for today, thank you very much. I'm Robert Johnson, and thank you for joining us.